Welcome to the deep dive. You know, it feels like the big question everywhere lately is, are we actually heading for a recession?
It really does.
Yeah, we should probably dig into those signals, see what they're really telling us.
Exactly. Yeah, we've got a few pieces here by Gustavo O. The titles kind of say it all. Can we avoid the R? It's coming. Jobs, jobs, and jobs. Mounting pressure and unsynced.
Right.
And they cover quite a bit, recent GDP, what's happening with jobs, even some pretty unusual stuff in the financial markets. It paints a picture, definitely. Maybe a complicated one.
Yeah, intricate's a good word. So our goal today really is to try and cut through some of that complexity. Let's figure out the key trends these analyses are highlighting, look at the different ways things could go, and hopefully give you a clearer picture without, drowning in data.
Sounds like a plan.
Okay, so where should we start? Maybe with that GDP report. The Q1 numbers grabbed a lot of headlines.
Yeah, let's do that. So Q1 GDP, it actually contracted, down 0.3% compared to the last quarter.
Negative 0.3.
And the main reason, interestingly, was a big jump in the trade deficit.
The trade deficit, why?
Well, it looks like you, as companies, were essentially bringing in a lot more goods, probably getting ahead of potential tariffs, front-loading orders.
Ah, okay. So rushing to buy before potential price hikes from tariffs. That makes sense. So the thinking is this might just be a temporary blip then, not necessarily the start of a bigger slide.
That seems to be the expectation, yeah. If or when tariffs kick in, that trade deficit should narrow again in Q2.
Right.
It probably won't vanish, but it shouldn't drag down the overall GDP number quite so much.
Okay, so a negative headline, but maybe with a less negative story for the next quarter's report. Got it.
Potentially.
But there was also some genuinely positive news
Yeah.
kind of buried in that GDP data, wasn't there? Something about investment.
Absolutely. That's a key point. If you actually strip out that negative trade impact, the GDP figure would have been way worse, like down around 4%.
Wow. Okay.
What really propped things up was strong investment. The analysis highlights specifically hundreds of billions of dollars American firms have been pouring into things like AI infrastructure.
Hundreds of billions into AI.
It's
That's a
huge.
serious amount of capital.
It really is.
So is the idea that this level of investment plus, consumer spending holding up, could that be enough to keep us out of a technical recession right now in Q2?
That's definitely the more optimistic take presented, that this investment provides a pretty significant buffer against other pressures.
Okay.
But it's worth saying the general mood among economists and business leaders seems to be getting more cautious.
Yeah, which leads nicely into those predictions of recession. I mean, that article titled "It's Coming" wasn't exactly subtle.
No, it certainly wasn't. The analysis points out you've got more and more economists, more C-level execs too, now calling for a recession this year.
This year.
Yeah, possibly starting as soon as Q2. The author notes that some indicators are starting to, quote, discount economic stress within the next 12 months. The probability is seen as increasing.
So the idea is, even if, say, the trade disputes got sorted out tomorrow, the slowdown might already have too much momentum.
That's a really important point raised, yeah. The threat of tariffs has probably already hurt exports coming into the U.S. And even if tariffs are ultimately avoided, that period of uncertainty could still mean, well, price increases down the line, a kind of supply shock, as companies maybe rethink supply chains or just adjust pricing.
That sounds like a tough spot. But the analysis also mentioned a potential upside. If a recession did happen, that caught my eye.
Yeah, it's an interesting perspective. The author suggests that a recession, assuming it's, managed okay and isn't too deep, could actually be healthy in a way.
Healthy? How so?
Well, it could help clear out some excesses, maybe some overspending, inflated valuations in parts of the market. Basically wipe the slate clean a bit to set up the next growth cycle.
Right, a reset. But obviously that comes with the caveat that there would be some real economic pain involved for people.
Oh, absolutely. Precisely. It wouldn't be painless. And the market reactions, the analysis also touched on investor behavior, how we've sort of been conditioned over the last, 15, 17 years?
Ah, the buy the dip reflex. Yeah. We've seen so many V-shaped recoveries, it's almost automatic for some people now.
Exactly. And the point made is that the next few months could really put that strategy to the test. Will it work this time, given these underlying shifts?
That's a good question. Okay, let's pivot to the labor market. That's always crucial. The Jobs, and Jobs article looked at the latest data. What are the key signals there?
Right. So the upcoming unemployment report, the expectation is for a small rise to 4.2%.
Okay.
With labor force participation holding steady around 62.5%. But digging a bit deeper, the JOLTS report that tracks job openings, it shows a clear downward trend in available jobs.
Fewer openings, that's usually a leading indicator, right?
It can be, yeah. And what's particularly striking, or maybe concerning, is that apparently 80% of the current job openings are concentrated in smaller companies.
Oh, under 250 employees.
Exactly. And those smaller firms are often the ones, most vulnerable if the economy does turn down.
Yeah, that definitely feels like a bit of a red flag. What about unemployment claims?
We're seeing a little uptick there, too, both in new claims and continuing claims. The author cautions it's not at a worrisome level yet, but it's moving up.
Huh.
And maybe the starkest stat is the ratio of job openings to unemployed people. Just 3 years back, it was 2 openings for every unemployed person.
2 to 1, yeah, I remember that.
Now, it's 1 to 1.
Wow, okay. So the labor market still looks okay on the surface maybe, but definitely some cooling signs underneath.
That seems to be the message, yes, showing some early signs of a slowdown.
Now, the piece, mounting pressure, seem to pull a lot of this together, especially thinking about recent inflation data like the PCE index and those Q1 GDP figures we discussed.
Yes, exactly. It sort of reinforces the idea that the initial GDP print, while maybe skewed by trade, still sets a tone for potential deceleration. And it adds another data point, container volumes. Specifically from China, arriving at the port of LA, they're down almost 40% compared to last year.
40%, that is a huge drop. What are the implications of that kind of slowdown in goods flowing in?
Well, the obvious one is just, less economic activity tied to that trade. But the other risk the analysis points out is scarcity.
Right.
If demand stays relatively firm, but the supply of goods coming in drops that much, well, that can push prices up.
The stagflation risk, slow growth and rising prices at the same time.
Precisely. Which is a really difficult scenario for policymakers, particularly the Fed.
And speaking of the Fed, all this must be weighing on their minds ahead of the next FOMC meeting.
Absolutely. The analysis suggests that while maybe no big move is expected at the very next meeting, if these slowdown fears keep getting confirmed by incoming data, then the pressure could really mount for them to potentially act, maybe cut rates, as early as June.
June. Okay, so that's something to watch closely.
Definitely.
All right, one last piece here, the Unsynced article. This one focused on some weirdness in the financial markets. Correlations behaving strangely.
Yeah, this is fascinating. What's happening right now is you're seeing an unusually high correlation between things that don't normally move together so closely. Specifically, long-term U.S. Treasury bonds, the S&P 500 stock index, and the U.S. dollar.
Okay, wait. Usually treasuries and the dollar are like safe havens, right? When stocks go down, people rush into bonds and maybe the dollar.
That's the historical pattern, exactly. In times of stress, they tend to move inversely to stocks, but right now they're kind of all moving more in lockstep.
Huh. Why is that happening? And does it matter?
Well, the why is complex, likely tied to all the uncertainty we've been discussing, especially around trade and Fed policy. And yes, it definitely matters. For one, these kinds of correlation spikes can really mess with quantitative hedge fund models. The algorithms aren't expecting assets to move together like this, and it can cause unexpected volatility or losses.
Okay.
And maybe more broadly, it undermines the whole idea of a traditional balanced portfolio. Holding bonds to offset stock market risk doesn't work as well if they're both falling together.
Right. The diversification benefit gets weaker.
Exactly. The author kind of frames it as the market being out of sync, possibly until there's more clarity, especially on trade, allowing for a kind of rebalancing of expectations and asset movements.
Okay, wow. So let's try and pull this all together. It's definitely a mixed bag, isn't it?
It really is.
We've got that weak headline Q1 GDP, but mostly because of trade. And underneath that, surprisingly strong business investment, especially in tech like AI. But at the same time, there's this growing chorus of recession warnings, backed up by some cooling in the job market, fewer openings, especially at vulnerable small firms, that 1-to-1 ratio.
Right, and the drop in shipping volumes.
Yeah, the port data. Plus, these really unusual market correlations, where safe havens aren't acting quite like safe havens should.
It paints a complex picture, for sure. Lots of conflicting signals.
Bottom line, there's no simple answer yet on whether we avoid the R word, as one article put it.
No, not definitively.
Yeah.
But hopefully, understanding these different pieces, the GDP drivers, the investment strength, the labor market cooling, the market sink issues, gives you a much better handle on the forces at play and, what the potential scenarios are.
Absolutely. It provides really valuable context. So maybe a final thought to leave everyone with as you digest all this information.
Okay.
Thinking about all these indicators we've touched on, GDP, investment, jobs, inflation, those market correlations, what's the one piece of data you'll be watching most closely yourself over the next few weeks?
Yeah.
What sign would either make you breathe a little easier or really heighten your concern about where things are heading? Something for you to think about.
That's a great question to ponder.
Definitely keep following the data and the news. Thanks for taking this deep dive with us.